Welcome to Closing Bell. I'm Sarah Eisen in today for Scott Wapner. This make or break hour starts with a retreat from records as stocks pull back from all-time highs. Here's your scorecard with 60 minutes to go in the trading session. We are seeing stocks give back some gains, as mentioned, down 0.3% on the S&P 500, so nothing extreme. The Nasdaq pulling back 0.4. We're pretty much flat now into the Santa Claus rally. This is the third day in, 5 more to go. I think 4 more from here, actually, which is a historically very strong period for the market. Materials, the hardest hit sector right now as gold and silver fall from those record highs. Discretionary and tech also in the red, while energy and utilities are posting gains today. And that leads to our talk of the tape. Should you lean into the broadening of the market that has been showing new signs of life as we close out the year? Month to date, we're seeing groups like financials and industrials outperform tech. Let's ask Palumbo Wealth Management's Phil Palumbo. Welcome. It's good to have you.
Thank you. So
how are you positioning? You manage high net worth clients, investors, entrepreneurs. How are you positioning them into 2026?
Yeah, so first, the wind is at our back as it relates to the overall economy, and which translates into earnings, which I think will be another up year for the market. And so with all that wind at our back, I do think that translates into the other 493 companies. And the question everybody has to ask themselves, well, why is that? And for me, it's about the Fed cutting rates, so rates going lower. That'll help the other 493 companies. And then I think a lot of these companies are going to integrate AI into their companies, ultimately increase in productivity, which will see their earnings start to increase. So I think those are the main reasons why you can see a broadening out.
So you expect more Fed cuts? Because we got 3 this year.
Yes.
That was more than what was expected initially.
Yeah, I do. I do expect that. And I do think the new Fed chair will be dovish. So I think overall we'll see a situation where rates do go lower than we are today from a Fed cut situation. I think it makes sense looking at the labor market cooling a little bit. And I think that inflation is not problematic. And with that, I think it's a recipe for to continue to cut rates.
And then you expect next year to be the year that we start to see the AI impact on earnings?
I do.
Higher margins? What does that look like?
Well, first of all, I think you're seeing it already, right? And a lot of companies that are implementing, like Salesforce is one that they implemented with their agent force, and you're starting to see it in their earnings now. So you're starting to see it already, and I just think
Salesforce is one, but it got punished this year.
It did get, there's an overhang right now with software companies, right? It's this concern about AI taking over their business, less seats within their business. But if you look at Salesforce and their business, they're thriving, right? So in terms of the agent force and their implementation of that, I mean, that alone is up 330% year over year. The data cloud and that business combines up 114% year over year. It's now a $1.4 billion piece of their business.
Why do you think the market's not giving them credit?
It's because
down 20% this
year.
year.
Because just like anything else, everybody's concerned that AI is going to take away part of their business, and other people are going to use AI, develop software like the CRM. But at the end of the day, Salesforce dominates in CRM. That's not going away. In fact, they're using AI to make their business even better. And if you listen to the CEO and they talk about the rule of 50 coming 2030, I mean, they're doing a great job allocating capital. It's trading even less from a valuation perspective, less than many of the software companies out there right now. So I think you're going to see a lot of implementation of AI into businesses, which you'll see productivity enhancements overall, which will translate into earnings power going into.
So Salesforce is one. Where else are you spotting winners? Especially interesting opportunities here where you think there's some market dislocation.
Yeah. So Sarah, I say it all the time. If someone said sell all your stocks in your portfolio, what would you buy? And I would buy Google. Google to me, and the big
even after the run.
Even after the run, the big question I get all the time from clients is, Phil, what's going to be the biggest winner of this AI run? And I say it's going to be Google. Google is the most vertically integrated business of all the businesses out there.
And you've said that. I just want to give you credit before this year. And
I did.
It's helped you have a good year.
It has, correct. Yeah. So, I mean, and Google just, I think, has it all, right? Gemini is just a phenomenal product. Their TPU, now they're selling their TPUs to Anthropic as an example. So now they can compete in the chip space. And YouTube, there are more people watching YouTube than there is Netflix. And their Google Cloud business is growing phenomenally well at 34% year over year. And their backlog is up 82% year over year. So we're talking about an incredible business that's only going to thrive. And that's why you saw Berkshire Hathaway took a position in it recently.
I know. It's just, coming into the year, everyone was worried that Google was existentially threatened by OpenAI and ChatGPT. The whole search business was going to be like the competition was coming and they wouldn't survive.
Yeah, which I totally get that. But the opposite is I think the CEO is an incredible CEO and they executed really well. And now the momentum is at their back.
So Google, top pick.
Yes.
Salesforce, clearly.
Yep. And Amazon. So Amazon's only up 6% year to date, right?
Lagged.
Yep. So it's lagged because of the tariff overhang, which is true of many companies out there. So I think going into 2026, a lot of the tariff overhang now is going to fall by the wayside. Similar with the AI overhang with software. I think a lot of that falls by the wayside, and you start to see e-commerce, and you see investors give Amazon credit, right, for the e-commerce business where they laid the foundation. I think you see margins expand there. Their AWS business, the last quarterly print, they hit 20%. Their backlogs are phenomenal. And I think their AWS business in general, the cloud business, is only going to continue to thrive. You know, they dominate in that business specifically. So I think, and then their ad business is up 20 to 25% growing. And there's and it's very profitable as well within the company. So I like those three companies a lot.
Well, on that note, Phil, sit tight because, as you noted, Mag 7 stocks have been diverging as the year comes to an end. 2026 could see that divide widen as AI spend comes under more scrutiny. Mackenzie Sagalis has the details. We were just talking about Amazon lagging. Mackenzie, what else are you watching?
So that Mag 7 trade is splintered, and the divide really comes down to who's converting AI spend to actual margin. So what I'm watching, let's start with the laggards. Microsoft, Meta, Apple, and Amazon all underperforming the S&P this year. Amazon's in last place at 6%. Meta had its worst day in 3 years after raising its CapEx guide. CEO Mark Zuckerberg has poured tens of billions into AI talent, reorged the AI unit 4 times in 6 months this calendar year, and still no clear payoff. Without a cloud business, the return story is better ads. The winners, they look different. Alphabet owns the full stack, as you and Phil were just talking about a minute ago. Chips, cloud, distribution, and its AI model, Gemini. Those shares 66% higher with margins expanding. NVIDIA has roughly 90% of the AI chip market and gross margins in the mid-70s. Everyone else's CapEx is NVIDIA's revenue. And then Microsoft is in the middle, 40% Azure growth last quarter, the biggest spender among hyperscalers, but also the most exposed to the AI arms race. It's got $300 billion committed from OpenAI and a new deal with Anthropic. And the question is whether the backlog justifies the build-out. Now, the setup for 2026, if models keep converging, and they are, distribution matters more than who trained the best model. And that could reshuffle this board in Apple's favor. Sarah?
Okay, Mackenzie, thank you. Let's bring in Obermeyer's Ali Flynn Phillips and Crossmark Global Investments Victoria Fernandez. Phil Palumbo is still with us. On this conversation, Victoria, how do you feel about some of the big tech names and specifically the divergence that Mackenzie was talking about? Does it present opportunity for you?
Yeah, I think you definitely have to start looking at the tech space, not as just, you know, one big group that you can just kind of pick any name in there and you're going to do well. There's definitely going to be some divergence between those names, as Mackenzie was talking about. You've got to look at those that you think will actually have a return on the investment from the CapEx component that they have. And I think you also have to start looking at maybe the second derivative of the AI play. What are those companies that are actually going to put it to use the best? Yeah. Those are the companies that I think you can look at investing as well. So tech will be a little bit trickier, although, Sarah, they are expected to be almost 50% of the EPS growth in 2026. So there's still a lot to be made there.
Yeah, I mean, that's, Phil, it gets to your point. So Amazon, you think it presents an opportunity here. And then on the second derivative, you mentioned Salesforce. What other sort of companies do you think will be AI beneficiaries?
Yeah, so on the second derivative, on the power play, Bloom Energy. Bloom Energy had an awesome year this year, up 288%. It's in our Palumbo Emerging Growth Strategy. You know, we're big believers that, you know, they have a great business model where they're able to provide electricity anywhere without utilizing the power grid. So we think Bloom Energy is a great second derivative of current AI movement that we're seeing today.
So that's kind of a continuation story.
Correct.
Of what we saw in 2025. Ali, what about you? How do you play the AI story in 26? How does it look different and the same than this year?
Well, I'd say, Phil, and everyone's brought up some good points. I mean, we, for instance, really do like Google, Amazon, some of those other things. But I like the idea we're talking about the second or maybe the third derivative. A good example to us would be Schneider Electric. Global electricity demand is reaccelerating, driven by AI, electrification, data centers, and decarbonization. And this is no longer a cyclical story. You have sweeping policy mandates, rising utility CapEx, and real wide grid failures, which are forcing sustained infrastructure investment. Schneider is a direct beneficiary for the global electrification. Their products are instrumental in increasing energy efficiency. And also they spent the last few years transitioning from a cyclical hardware company to one that has reoccurring revenue. Another example to us would be ASML. It's a pure play within the AI build out. ASML makes the machines that make every advanced chip out there. And so as AI moves from video to multimedia models, compute intensity is increasing. And AI chips are critical for that production. You're seeing more orders and visibility, and essentially tight supply, rising demand will be the next leg higher.
Ali, I noticed you also mentioned healthcare as an interesting underperformer. Is that Is that one that you want to get into? And when do we see the AI benefit there? That's been part of the excitement on the AI story, is drug development and healthcare changes.
True, and healthcare is one of those where, as you know, it's lagged the last 2 to 3 years for all sorts of things. Our focus there more is really earnings revision, easing policy risk, and you see a lot of M&A momentum. So it's more those aspects that are really encouraging as opposed to just really the AI angle of healthcare.
Yes, I mean, it gets to your point, Phil, about 493, the other 493, and when we'll start to see results. I guess the biggest question, which is kind of a circular question back to the semiconductors and the original AI, is just how quick this enterprise adoption will be and how big the payoff will be.
Yeah, that is the big question. And again, I do see 2026 and 2027. I do think the investments, listen, AI and implementing AI into your business, without a doubt, makes a tremendous difference. There's tremendous value in utilizing the tool. You know, Jensen Huang talked about this. When you give your employees access to AI tools, it could increase productivity by 2 to 3 times. I'm personally seeing it in my business, and I think many other businesses are starting to see it now, and it's for real, and it's only going to expand.
Why? What do you do in your business with it?
Everything from research component to marketing, which are the 2 components that save a lot of time for my employees. That's increase in the productivity and increase in revenue as a result of it.
Victoria, do you see it driving the economy next year in the same way? I mean, this year, the CapEx, the spending that has gone into AI, particularly in the first half of the year where we were seeing numbers like 20% into GDP, and it's still a big contributor to GDP. How do you expect it to impact the economy overall next year?
Yes, Sarah, I think CapEx is the key right there. I mean, we know that CapEx leads to productivity gains, as you were just talking about. We know that it leads to profitability as unit labor costs are kept low, margins continue to improve. That's one of the areas that we've been concerned with when it comes to earnings. How are they going to continue to keep their margins up? How are they going to continue these levels of earnings growth? And I think CapEx is a key component of that. But I think we'll see CapEx really start to broaden out. It's not just going to be the AI play that leads that CapEx drive. You're going to have all of these other companies that then start to come out because of the OB3 bill, and you get the tax benefits in regards to manufacturing, research and development, building factories. So I think you're going to see CapEx really start to broaden out. That's going to be a key driver along with the earnings growth and the consumer as well. You've had, Dana, you've had Jan Kiffin, people on today on the network talking about the consumer, and they'll continue to spend. Those 3 elements, the CapEx, the earnings, and the consumer, I think is what you're going to see driving the market next year.
But Victoria, do you get worried that the consensus is getting very bullish, not just sell side analysts, but all the conversations, everyone excited about growth, the impact of the big beautiful bill, the fact that we're lapping some of the tougher tariffs, the fact that the AI spend is still on fire. It's all becoming very consensus.
It is, and you can't look at it through rose-colored glasses. You have to say, wait a minute, there's a chance of another government shutdown. There's a chance that we're going to see inflation start to move higher because companies have said they have not passed on all of the tariff costs as of yet. They're going to continue to do that incrementally. So you can see inflation continue to move higher. The labor market could weaken. There's a lot of elements out there that I think could continue to be warning signs for the economy. So you have to take that into consideration. And we know it's a midterm election year. You typically have a pretty large intra-year drawdown, 15 to 19% in a midterm election year. So I think it's going to be a very volatile year. You're going to have to be very tactical in where you put things to work in 2026.
Where's your hedge, Phil? I bet you didn't expect your hedge, gold, to be up, I don't know, 70% this year or so.
Yeah, so gold's been a core part of our overall portfolio. 2 main reasons why we implemented it. We did research going back 50 years, and when we did that, we realized that gold has really hedged during a major downturn, number 1. And number 2, when there's inflationary trends moving upward, gold's a good place to be, right? Which worked in the 70s, really didn't work, though, in the big move that we had in inflation.
You think that's what the gold move is about? Inflation?
No, it's not about inflation. The gold move, I really think, is 2 things, right? Number 1, I think it's more about dollar down, interest rates down, right? I really think it's that simple.
Yeah.
The other part is there something around the corner that we're not seeing that can create an exogenous shock that nobody knows. It's like the unknown unknown. That's what concerns me, even with the price of silver moving up. So just like anything else, like head on a swivel as you're an investor and just making sure you understand that maybe there is something going on that we're not talking about right now, because all we're talking about is the same thing, which is AI, but maybe there's something else going on that we're not seeing.
I know, you just don't usually see stocks at a record high and gold having such a good
time. You're right, exactly. So there is some type of issue going on, or that does concern me, and so diversification is the key to that.
And so what, 10%? How much?
10%. We started at 7.5%. Now we got to 11, 12. We pared some back. We moved into Bitcoin with part of that paring back. Not that we think gold and Bitcoin are the same, but we thought Bitcoin is a possible store of value is how we look at it. So longer term, we think it could be a good value.
All right, guys, we'll leave it there. Great setup conversation. Thank you very
Sarah.
much. Ali, Victoria, and Phil, it's good to see all of you.